What is up, you guys? Today we are going to go over the 10 stocks that I'm going to be watching really for the next 6 to 12 weeks, because these stocks aren't all going to be, things that I'm long on. I'm also going to be short on a couple of these, and I'm going to explain in detail why I am bullish or bearish for the stock and why I'm watching it in the first place. So first of all, guys, make sure to turn that like button blue. Make sure to hit the subscribe button. It really helps the channel. We're almost up to 2,000 subscribers, guys. It really helps. Also, guys, if you want to learn how to trade stocks, if you want to take your trading or your investing to the next level, I'm giving away 7 free days of my private academy. No hidden fees, nothing stupid like that. Just click the link down below. You get access to 55 hours of different courses and lectures. You get to go live with me and the team of 252 traders every single morning, go over what I'm trading, why I'm trading it, and you get access to our private Discord. So 7 days for free. I will put the link down below. The first stock is going to be American Airlines, and the ticker is going to be AAL. So right now, we all know what American Airlines is. This has been one of the craziest stocks that I've seen in a long time. I actually took some shares in this company all the way down at $10.41 a share. I sold them around $15, made $3,000 in profit. And of course, I sold way too soon. This has been such a volatile stock. Let's take a look at the fundamentals real quick of the company. Right now, you can see that they have a $7 billion market cap, an EPS of negative 1.87, and a PE ratio of nothing because they are not a profitable company. As of right now, they do not have a dividend, as we would expect, and they are close to their 52-week low. Now, I put this in here not specifically for calls or puts or if I'm going long or short, but this has been a very volatile stock. And with the whole Rona situation going on, I personally think we're going to see a huge second wave. And one of these things that you're going to see with a lot of the companies I'm talking about right now, they all have to do with a second wave and how the company's going to perform after this. So of all of the airlines, and I've talked about this before, I made a video on the airlines. I will put it up here and I'll put it in the link down below. American Airlines is my least favorite financially. I feel that if any of them were to go bankrupt, American Airlines would be the one. And we're starting to see that while the country's opening up, if we have to start locking down more and more cities, I think today actually they started locking down parts of China again. This could become a problematic company once again. So I'm not saying that I'm taking a position in this. I'm not telling you guys to take a position in this. I'm saying this is something to watch if you're someone who enjoys volatility. The second company that I will be watching will be CCL, or Carnival Corporation. This is a company that I had a pretty sizable position in. I had about $35,000 worth of stock down at $7. I sold for not too good of a profit, honestly, at the time. I really should have held. It really has recovered a great bit at this point. I got out way too soon, and I'm not upset about it because at the time things were not looking too well. Since I got out, we have ripped up almost 129%, sold off, and now we're coming back up. Now, looking at quickly over some of the fundamentals of the company, we have a market cap of $15.7 billion, an EPS of $2.70, PE ratio of a little over 7, and obviously no dividend. The company had an insane dividend, but they had to cut it. Now, something that worries me about not only this company, but all of the cruise line companies is the fact that if a second wave were to happen, they are not going to set sail. So we saw recently that, originally CCL was supposed to only delay until June. Then that got pushed back to August. Sold a whole bunch of tickets for August, like $28 a day, something ridiculously cheap. And now they're being told that they can't start sailing again till maybe September, October. And now they took a huge loan out for 11% interest, which is not a small interest rate, especially for the amount of money that they took out. So this could be problematic for a company like Carnival if a second wave does come out, if the second wave actually shuts down more and more cities, if they keep delaying the date that they can start to sail again. What if it comes out that, hey, they're not going to be able to sail at all in 2020? Will this company be able to get through that? I don't think so. Now, if I were to get puts or short, long term, any of these cruise companies, it would definitely be Norwegian Cruise Line, which is ticker NCLH. I didn't put it on here, but I'm counting all of the cruise lines when I talk about this. So that's number 2. Good old Disney is going to be number 3. We all know Disney, monstrous market cap, $211 billion with an EPS of $2.66 and an astronomically high PE ratio of 44. That's crazy for a company like Disney, but let's kind of get into it. This is a company that I really, really like for the long term, pre the whole Rona situation, but I am pretty bearish on Disney for the next couple of months. I really am. They were all the way up at $153. They sold off down to $80. But when you look at Disney, right, if you break the company down, you have the main things like theatrics and movies, which are not being played right now, right? Every single movie is going straight to on demand or straight to streaming, which is not really too big of a problem, but still they are losing money in the box office. If you look at another big sector is parks, right? Parks have been closed down. Disney World is set to open in July. I don't think that's actually going to happen. That's a big piece of it. Now, the other thing you have to realize too is Disney Cruises is another big aspect of the travel and amusement section of Walt Disney. So you have all of these cruises that Disney's not running. You have all these resorts. I know Disney owns an insane amount of resorts, right? In the Orlando area and Kissimmee area that are just not open, right? And if they are going to be open, it's not like people are going to be paying full price to go travel to Disney. And I think that if you look at the streaming service, while the numbers are impressive, I've talked about it before in a lot of videos about Disney, they're not really coming out with, canon content, right? A lot of the canon content for Disney Plus came out when Disney Plus actually first started, of course, to entice viewers, to get them in. But I see a lot of problems for Disney in the next, 6 to 12, maybe 18 weeks. This doesn't mean I don't believe in the company long term. I love the company long term. If we got back down to $80, I would for sure add it to my long-term portfolio. But I think that if we get some news coming out that, hey, Disney can't open till August, Disney can't open till September, this stock is going to take a huge dive. The next stock is going to be fan favorite DKNG or DraftKings. This is a company that just recently IPO'd, I think about 2-3 months ago. The market cap is $12.7 billion. The EPS is 6 cents, and the PE ratio is an astronomical 758. Obviously, that PE ratio doesn't really matter because I have enough information to really come up with a strong metric. But I get a lot of people who are asking me, like, should I invest in DraftKings? Should I trade DraftKings? And for me, I don't really touch IPOs like this, but I figured that I would go over it. Now, one bullish reason for people to be investing and taking, positions to the upside on DKNG is because sports are going to be coming back. And that is that's a topic that we're going to talk about going into Viacom, which is going to be our next one. But I don't think sports are coming back anytime soon. And if they do come back, I think we'll talk about that when we get into the next one. But as far as DraftKings is considered, I would not be taking a position in the long term right now. If it got down to $20, I totally would. I just don't trust it. I don't like it at these levels. I do think that online gambling is really good because you got to remember DKNG is not just sports, it's also online poker, online blackjack, online roulette. And with people not really able to go out to the casinos like they used to be, I think that that's really good for them. But we could see the stock take a hit now that bigger casinos are actually opening up. So we'll see. This is just a very volatile company that I would not be investing in right now, but we're definitely going to see volatility within this stock in the next couple of weeks. All right, the next stock is going to be Viacom. So for those of you who do not know, this is Viacom CBS. So the CBS, the television network, they own a bunch of other different things, but this company has a $15 billion market cap. They have a 4.31 EPS and a very, very attractive PE ratio of 5.78 with an annual dividend still going on, I believe, of now 3.8%. This is a company I actually really like. Now, one of the bullish things that I keep hearing from people is that Viacom is going to completely recover once sports come back. And, but I want to talk about sports for a second right now because I don't think a lot of people understand how sports have to come back, right? We see the UFC right now, and they are able to probably put on the best possible cards and best possible shows that they could put on. This is because they're pioneers in this aspect of sports, right? They are considered a sport. They have a huge deal with a company like ESPN. They're recognized all over the world, but they beat to their own drum. Dana can do whatever he wants, right? Dana White, the president of the UFC. So when I can't say the word. So when the whole Rona situation happened, he said, I'm just going to go rent an island. I'm going to build a facility. I'm going to fly the fighters out, or I'm going to go to Jacksonville, or I'm going to, go to my own Apex Center in Las Vegas, and we're going to put on shows. What you got to realize is it's not like the NFL couldn't do that. Obviously, the NFL has more than enough money to where if they really wanted to build a stadium on an island and fly out the players, they could. But the problem is the TV deals, because UFC is still on a pay-per-view model. So in order to put on their cards, what they can do is say, hey, we're going to charge you $70 for this pay-per-view. And it's working out really well because no other sports are open right now. So you have the hardcore fans like myself, you have the leisurely fans who will definitely be watching right now, and the people who don't ever watch, who want to see sports, they want to gamble, so they'll get their friends together and they will buy a pay-per-view, and that model works. But the NFL, the NHL, the NBA, MLB, they can't do pay-per-view models. So how do they make money, right? A very small amount of the revenue from sports teams is through these, deals with, CNBC, ABC, like these big networks, by putting their content, their games on the cable networks. The problem is, though, that's not enough money to keep a business alive. Each franchise, each team, no matter what league it is their own business. And the primary forms of revenue for a sports team is what, right? Parking. Okay, with the whole Rona, there's no parking. Sales on t-shirts and souvenirs. Well, there is none of that because there's nobody, at the actual game. Ticket sales are a huge thing. Box seat sales. There's none of that. There's nobody who is going to be at games, right? There is, concession stands, hot dogs, $25 beers. None of that, right? These leagues make their money by putting butts in seats and then having those people spend money as an experience at the game. Even if sports could come back, they're going to lose a chunk of revenue from that. But what you're seeing right now is, the NHL and the NBA, right? They're not necessarily coming back. I think that if it was a full season, they would not come back. They're coming back because they need to finish the season, but it's the playoffs. So they can just pump the games out. They don't have to really worry about eating too much of a loss. They can pay the players. They can get the games done with in about 6 weeks. But if you look at the MLB, where they play 187 games, of course they'd have to cut the season. The teams aren't going to make money. So the players, where are they going to take it from? All the players are going to have to take huge pay cuts, which might not happen. The NFL might be doing okay because if we don't get a huge, surge in cases again, they could come back and fall with maybe 50%, 60%, 70% occupancy in seats. But still, if this happens again, if everything starts to close again, which I'm not saying it is or it isn't, but as an investor, you have to think like this. If that were the case, then what's going to happen? How are these players going to, how are these teams going to make revenue? And these players, and if I was an NFL player, I would not be taking a 40, 50, 60% pay cut, right? The average running back in the NFL who's in the top is only there for 3.5 years, right? I'm not taking a monstrous pay cut if I only have a 3.5 year shelf life. Right. So I don't know. I think that Viacom is a great long-term play if you're going to get in for the next 4 years, but we'll see what ends up happening. But this is a stock that's going to be fun to watch, and I think it's going to be pretty volatile going into the next couple of weeks and months. All right, next stock to watch is going to be Play, which is going to be Dave & Buster's. The ticker is PLAY. Very small market cap of $813 million. EPS is 34 cents. PE ratio is 50. No dividend. This company's got stupid amounts of debt. I would be shorting or getting long-term puts on this company. I do not think Dave & Buster's is going to be around in 3 years. I really don't. Like, if there was anywhere to catch a virus, it's going to be at Dave & Buster's, right? Look at Chuck E. Cheese. Chuck E. Cheese is going to go out of business. This is the adult version, right? If it's like the Dave & Buster's business model didn't really work before all of this, it's not going to work after this, in my opinion, right? Yeah, there are people who want to go out. Yeah, there are people who are going to want to get dinner. But I think that after the whole Rona situation, you're not going to have a bunch of people who want to go out and get nasty, like bar food that's microwaved. I don't think that people are going to want to go get overpriced beers. And I don't think people are going to want to go play video games that personally I think are subpar than what you could play at your house and touch a whole bunch of screens and do a whole bunch of, if there's anywhere you're going to catch a virus, it's going to be at Dave & Buster's. And it's not like I have a personal vendetta against Dave & Buster's. It's just there's so much debt. I feel like the business model was great 20 years ago, but it's not that big of a deal now. You know, if this company wanted to really change things, they'd have to put so much money into like better technology, virtual reality, like do some crazy stuff technologically to drive people to their stores. The other thing, they were supposed to fully open all of their areas. That was their plan. They're supposed to fully open all their stores by July. It doesn't seem like that's happening. And if a second wave comes and they say, you know, because Dave & Buster's is last on the totem pole when it comes to opening up, you know, the economy. And so if it gets pushed back to August, September, October, November, they're just bleeding money right now. So I think this company short term could go up, but overall, I hate this company and it should be fun to watch. All right, next one is going to be Ruth's Hospitality Group, which is, as you guys probably all know, Ruths Chris Steakhouse. Market cap, very, very small, $278 million. PE ratio is 11, and the EPS is 84 cents. Now, why do I hate this company and why do I, you know, would I take puts or shorts or why do I want to watch this, right? It's not necessarily that I don't like the restaurant industry. There are a lot of restaurants that are doing well. There are a lot of restaurants that are doing decent. And then there's restaurants like Ruths Chris that's probably hanging on by a thread. Not only during the Rona situation do I think it's a problem because who's going to spend hundreds of dollars to go get a steak in a styrofoam box with some mashed potatoes, but I think that the problem is also that this is not a business where like you go and hang out for lunch with your friends. This is not a restaurant where I would say, you know, maybe bring a girl on a date, but this is more of a business restaurant where like big CEOs, big chairman of company, when they're on their business trips, they go out to Ruths Chris and they have a great dinner or a good lunch and they talk business. And you have a mix of a company that, you know, nobody's going to do takeout, so they're bleeding right now. Once it does open, who's your primary people who are going there? There's not going to be a lot of business traveling anymore. I don't even think for the rest of, you know, I don't want to say existence, but for at least the next 10 years, I don't think there's going to be as much business travel as there was 6 months ago, right? I'm not saying everyone's going to stay home and no one's going to travel for business, but I think it's going to be, you know, a lot less people are going to want to go out and do that. So you're going to have less customers. You're going to have no takeout at all. You're going to have really the customer who wants to go to Ruths Chris is just not going to be there. This is a company that's bleeding money, and I do not see them having a bright future. But in terms of volatility, this is a company to be watching. Next one is Smile Direct Club. The ticker is SDC. This just kind of recently IPO'd back in October. So market cap is $3 billion, pretty big market cap. EPS is negative 32 cents. Obviously, no PE ratio, no dividend. This is a company that I just took a very, very small position in right now. I have 800 shares. I'm up $52, right? Nothing crazy. I was up $1,500 when I opened it last week. But this is a company that I think is very risky and very speculative, but could be a great investment in the future, right? The balance sheet, the income statement don't look the best. Like I said, from a financial standpoint, it's not something like a Warren Buffett would invest in. But for me, it's very speculative, but it could have a very bright future, right? We have these at-home businesses, these online businesses, these e-com companies that are doing amazing things. Anything that has to do with like your teeth and doing it online, I think has a great, bright future, right? The idea of Invisalign, you know, that was huge back in the day, but now the fact that you don't even have to go to a dentist and get the mold done, you can do it at home. That is a great business model, as well as, you know, the UV teeth whitening kits, all of the different things that this company is doing. I think they have a bright future. Is it a risky investment? Of course. Am I fine with the risk? Yes. All right, let's talk tailored brands. I made a whole video on this, went over like my 25-minute bullish thesis on this company, why I invested it. I will put the link below and I'll put a little tag up here somewhere. Market cap $53 billion, EPS 49 cents, and the PE is at 2, no dividend. This is the company that owns Joseph A. Bank and Men's Warehouse. I'm not going to stick on this too much, like I said, because I already made a whole video on it. Right now, I have a pretty small position, 3,500 shares. I'm down on like $1,100. I'm not going to add anything to this position, but this is going to be something to watch in the next couple of weeks. They're supposed to file for Chapter 11 bankruptcy. They came out after earnings, said that it wasn't going to happen. It ripped 70%, and now we're just kind of sitting here. So this is, you know, in no way, shape, or form a safe investment, But if you want to see why I took this position, go check out that video. Okay, and the last one is kind of a cluster, but primarily I'm going to say Zoom. But in general, I'd be looking at these online work-related companies that we've been seeing, like Slack, like Zoom, like Ring Central, any of these companies that, help businesses. Twilio is another one. Any of these companies that help businesses online, because in the future, I really think not a lot of companies are going to go back to work full time. We have companies like Twitter, companies like Square that say they could never go back to work, or they never plan on going back to work, because working from home really is so much easier. As a company, you don't have to spend all that overhead. Working from home, if it can be done correctly, I think is something that we're going to see really. If you look 30, 40, 50, 60 years ago, people used to work 12, 13 hours a day. Then they legally mandated it to 8 hours a day. Now you have people who like to work 4 hours a day. Just as we've seen the work culture switch to like less and less work, I think we're actually going to see the work culture switch to, more stay at home jobs. And I think most people actually perform better at their own home. But primarily for this one, we're going to talk about Zoom Communications, right? Market cap is $67 billion. This is just crazy over the past couple months. EPS of 18 cents. The PE ratio, this is not a lie, is 1,321. Not something I'd be investing in right now unless you're planning to hold Zoom for a decade. But this is just crazy. This company, since October, is up 300%. So not a long-term investment. For me, it would have to fall back down to $100, but something I want to watch. I truly feel that these companies are kind of just sitting on, a very like a glass unstable base right now. And at any time, these could topple, because you have to think, right? Yes, these companies are doing really well. Yes, in the future, these companies could do amazing if people continue to work from home. But the stock market values things in the future, right? And that's why some people don't understand, like, how does the stock market move? Everything is, doing well, and it's going down, or everything's, not well, but it's going up. It's because the stock market prices in the future. So if Zoom comes out with earnings next quarter and they were great numbers, but it falls, people are like, well, why is this happening? And it's because the price of the stock is already too high for what it's worth. So these types of companies, I'm definitely going to be keeping an eye on. I'm not going to be starting a position on something like Zoom right now. But let me know what you guys think. Let me know if you are watching any of these companies, if you're trading any of these companies, let me know. Comment down below, hit the like button. Also, guys, if you want to learn how to trade stocks, if you want to take your trading or your investing to the next level, I'm giving away 7 free days of my private academy. No hidden fees, nothing stupid like that. Just click the link down below. You get access to 55 hours of different courses and lectures. You get to go live with me and the team of 252 traders every single morning. Go over what I'm trading, why I'm trading it, and you get access to our private Discord. So 7 days for free. I will put the link down below. Thank you guys for watching. Until next time, I'll see you.